explain. I will take this question into two parts. He is talking about a case where whether I have to get prepared for the change and what is the homework which I have to do. Necessarily I have to do a homework because my stakeholders will be having a totally different results when I am charging a higher depreciation than what I have budgeted in the normal scenario. If I have applied schedule 14 rates, if most of the companies, more than a small size companies, normally they use an economic useful life as a pattern. For them it may not be any problem. Only thing is the number of years which they have arrived at compared to schedule 2, whether that is significantly varying, you have to align it. That's a thing which you have to do. In your example where you are talking about a retail industry where you are talking about laptops, computers, desktops, etc., which is from 6 years, it is coming to 3 years. If you have applied the 6 years period, necessarily you have to align to only 3 years period now. So accordingly, you have to see what is the remaining economic useful life of all your desktops, laptops, etc. when the act has get notified. If it is already exhausted, that period is already over, the entire thing will go and get adjusted in your reserves and surplus. So it may have an implications. In certain cases, in fact, this will be beneficial in some cases, it may not be beneficial in some other cases. Some companies have said that if the depreciation is going to be adjusted, not in my P&L, but it's in my reserves and surplus, where I don't have anything connected with my reserves and surplus for compliance with the Companies Act, I'm very happy because my current year profitability or the results will be much better than what I'm having, so I can show a better picture for the other stakeholders. That's one school of thought. The other side is where they had a feeling that this will have implications on my net worth, and because of the net worth, my investments which I have made in my subsidiary or associates, etc., before the introduction of 185 and 186, whether that will also have an implications. Yes, it will also have an implications. So you will not be able to contribute anything more, or maybe you have to say that their limit has been exceeded and you have to withdraw that existing limit also. That could be another situation. The related to that is that suppose if a company is saying that I am happy that everything can be adjusted in the reserves and surplus, but my depreciation charge to the P&L goes down in the P&L, and the company, I am assuming that if the company is in a MAT regime, that is, it's only paying minimum alternate tax on the book profits, that the company's liability for the taxation will be higher, because in my view the income tax doesn't have any provision for making an adjustment for what is adjusted in the reserves and surplus and bringing it back, because 40B of Income Tax Act, which prescribes the method of computation of book profits, doesn't envisage that this is the possibility by means of an act. So maybe we will wait and watch what is the stand which we will take. Having said that, I know what is the revenue will take a rule is that whenever an item is taxed, it is whichever is higher. Whenever an exemption is given, which is whichever is lower. So accordingly, they will not allow you to have an adjustment because it is legitimately available depreciation for offset.
Thank you. Madam.
Yeah.
In respect of unspent amount of
CSR, yeah.
which can be utilized, which is not utilized in a particular year, how is this to be accounted?
Okay. So there are two questions on this unspent amount of CSR. In fact, in one forum we are talking about is whether CSR has to be made as a provision first of all. It's the first question which has been asked. Because they said that I am supposed to spend, I will spend 2%. If I am not spent, what it says that I have to carry over this balance and disclose what is the reason where I am not able to spend this money. So whether provision first of all is required in my books of accounts or I can keep this out of my books of accounts is the first question which has come. The answer for that is if you read the Accounting Standard 29, it talks about a provision is defined both constructive as well as legal. So it becomes a legal obligation. Even though you don't have a requirement, it becomes a legal obligation. The legal obligation make you to have this. So accordingly, there is a past event. The act has been passed, and you have fulfilled all the requirement or any of the requirement with respect to CSR coverage, and accordingly this will be a provision to be created in your financial statement. When you have created the provision, you will debit your P&L account and credit your provision account. Maybe you will keep a separate track for CSR provision, you keep it separately. But during the year you have not spent any money. I assume that any money is not spent. That will be carried over in the same provision. So what will happen is, you will require to have two disclosure. One is according to accounting standard 29, wherever there is a provision, you are supposed to give a disclosure on what is the opening provision, what is the newly created provision, what is the usage out of the existing provision, what you have reversed, and what is the closing balance. That movement also you have to give for with the comparative details. That has to be given. That one disclosure has to be there. Apart from that, under section 135 on the CSR, it makes a mandatory disclosure. If you have unspent this money, you have to mention what is the reason why you are not able to spend this money. This is the second disclosure which is required. So accordingly, what will happen is, the unspent money of the current year, which is, I assume, I will take an example, number of say 10 crore, and next year you have another 20 crore has to be spent based on 2% of your profits, whatever may be. So the 10 plus that 20 crore, 30 crore unspent should have been shown as disclosed in the second year. First year you will disclose about 10 crore, and second year you will explain about 30 crore. The only problem which I am worried is, because the rules have been kept as a separate ball game other than the act, they may come out with a rule, because it's very simple to pass a rule. They can simply come out with a rule and say that unspent CSR money will also get attracted by the investor protection fund, and you have to transfer this after a period of time. So you will be left out with no choice other than to spend and find out what is the activity which you wanted to carry out. So that's the worry which I am having, because the way in which Companies Act has been drafted, Act has been kept simple, but all the provisions have been pushed to rules.
So the best answer is we should not provide?
You have to provide.
Yeah.
You have to provide. Because that's what I'm saying. Accounting standard
No,
will
we provide means then government may come for like unpaid dividend account. So
possible.
Yes. Now, what about the second-hand machines which I am buying? Now, the previous owners, the
Okay.
life also has been taken, or?
Okay, very interesting point. It's a judgmental point. Normally, an area where auditors and the management fight. I buy a second-hand machinery and do some additional modifications so that it will function. Most of the companies which I have seen in small companies, or maybe some of the automotive companies, they shift the production line of their parent company here, and then they will do some modifications and then use it for this. What is the economic useful life which I will apply for this? Because it might have been transferred after the economic useful life literally has been over at the parent company level, and it comes to this. Normally, there are two issues here, or maybe I will see it in two different angles. You are still permitted, I will first give the positive signal to you. You are still permitted to use Schedule 2 rates for a simple reason. Schedule 2 says what is the economic useful life for the particular asset. So it is a machinery, you still have that 15 years of economic useful life, you can start doing it. Having said that, on the flip side, the fight will start with the management and the auditors on really it will go for 15 years, because another accounting standard on impairment of asset will also have a rule. So if you are not going to use it for next 15 years, but you will be replacing within the next 10 years because it is cannot be used, my suggestion is that assess the economic useful life as the best optimum economic useful life according to the management's intention. Don't go by some other method. If your intention is going to be used for next 15 years, I don't have a problem. And if you are going to demonstrate that the machinery which has been shifted from the parent company to India is in running condition and it can be really create cash flows, you will not get impacted by accounting standard 28 on impairment of assets also. So that is the reason why the last video which I have shown, he is trying to balance between two child, but unfortunately sometimes a small slip will make the impact totally in a different situation.
well,
On the consolidation of subsidiary and associate companies, in case of private company, having a subsidiary company and also having an associate overseas joint venture company, the consolidation is required, right?
Yes, sir. If a private limited company is having a subsidiary or associate or joint venture, whether there is an exemption available for the private limited companies, as Dhanabal has quoted during our discussion on the handbook, he made one point. The Companies Act 2013 seems to not make a distinction between private companies and public companies. So even when they have defined the prescription for what is financial statement, that is what exactly I have shown on the third bullet of my definition of financial statement. I said they have not included cash flow statement if applicable. Like the same way, in consolidated financial statement also, they have not given any exemption. They have simply said a company which is having a subsidiary should prepare and present a consolidated financial statement.
So if it doesn't have a subsidiary, but it has only an overseas joint venture where it has 30% or less than that, or 20
Good point.
to 30%,
So,
then
maybe-
also it requires a proportional consolidation.
Understood, sir. Understood. I will answer this question. It was actually in that presentation for want of time where I have skipped this. Suppose if I don't have a subsidiary at all, but I have only a joint venture and I have only an associate. Even in that case, you are supposed to prepare a consolidated financial statement, because the definition for consolidated financial statement, they have given an explanation where they said that for the purposes of this section, subsidiary includes an associate and joint venture. So that means that is what exactly accounting standard 21 for consolidated financial statement we strongly believe, and the opinion is also that if I don't have a single subsidiary, never ever I need to prepare a consolidated financial statement. Even if I am a listed company, I need not prepare because it is not required. But when it is talking about a case where that section has prescribed subsidiary includes an associate and joint venture, you don't have a escape route.
Thank you, sir. We appreciate.
This is exactly what I said. செவிக்கு உணவில்லாத போது சிறிது வயிற்றுக்கு வியப்படும். Yes.
Yeah, last one.
In case of consolidated financial statement, you said associate and if I have an associate also, I should prepare a consolidated financial. It's on line by line consolidation or proportionate consolidation.
Okay. The question is simple. What she is asking is, I am supposed to prepare a consolidated financial statement if I have an associate, even though I don't have a subsidiary. But what is the method which I have to adopt? Whether I have to adopt line by line consolidation in that scenario? No, because the consolidation will be based on the accounting standard. So if I have only one associate and one joint venture, for the associate accounting, I will use accounting standard 23, which is talking about equity pickup or equity accounting. And for accounting standard 27, which is for joint venture, says proportionate consolidation method. Only if you have a subsidiary, for consolidating the balance sheet of the subsidiary and profit and loss account of the subsidiary, you will use line by line consolidation. Otherwise, for entire thing, you need not use a line by line consolidation. But the problem is, what you believe as an associate may become a subsidiary based on what I have described as total share capital and also a situation of control as the basis.
The depreciation. In asset, when major repairs are conducted, the usual, life.
Sir, I am not able to come.
The
Okay, a company is incurring major repair expenses, so in respect of the machinery, so whether that will impact the assessment of economic useful life. In my view, yes, because for example, if you are having a machinery, and what is prescribed in Schedule 2, if your accounting policy says that I am adopting the economic useful life as prescribed in Schedule 2, you can still continue to have 15 years. You don't have a problem even if you are incurring major repair expenses. But when you are going to the management, where you are saying that I have another 10 years of economic useful life, but on the 6th year I am incurring a cost equivalent to or repair expenditure equivalent to 50% of my WDV of the particular machinery, naturally it's a question mark whether your assessment of economic useful life is correct or not. So in that scenario, what is your accounting policy describes the way in which it has to be assessed. If your accounting policy says that I am simply adopting the useful life given in Schedule 2, no question can be asked by the auditor, because the auditor cannot qualify the accounts just because you are having a different thing, because the entire expenditure will also get charged in the P&L account. But on the other side, if you are saying that economic useful life is assessed by you, then the assessment has to be on this basis. After the 5th year, you need a very huge expenditure to be incurred, means necessarily 5 years is your economic useful life, maybe.
Seamless way of presentation, and also for the thought-provoking answers for variety of questions.